Have you ever wondered what separates a successful investor from a failed one? Is it sheer luck, insider knowledge, or something deeper, a mindset that transcends market trends and human emotions? Benjamin Graham's The Intelligent Investor is a masterpiece that answers these questions, offering a roadmap for financial success rooted in logic, patience, and discipline. In a world where speculation often masquerades as investing, Graham's wisdom is a guiding light for those seeking true financial independence. Published in 1949, The Intelligent Investor is often hailed as the Bible of value investing. Graham, known as the father of value investing, introduces principles that apply to all investors, from the conservative to the enterprising. The book's key themes include the importance of understanding the difference between investing and speculating, maintaining a margin of safety, and the necessity of emotional discipline in the volatile world of financial markets. It's not about beating the market, but about cultivating the right habits and mindset to grow your wealth steadily and safely. Now, let's dive into the core teachings of the book, chapter by chapter, weaving together Graham's principles into a cohesive and engaging narrative. The essence of investment versus speculation. Graham begins by making a crucial distinction. Are you an investor or a speculator? He defines an investor as someone who makes decisions based on a thorough analysis of a company's fundamentals, aiming for safety of principal and a reasonable return. Speculators, by contrast, gamble on market trends, short-term price movements, and rumors. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. This principle lays the foundation for the entire book. Graham emphasizes that speculation is not inherently bad, but should be approached cautiously and never confused with investment. He likens speculating to gambling, exciting but perilous if it dominates your financial strategy. He warns that during speculative market booms, even intelligent investors can get swept up in the frenzy. Understanding the nature of speculation and resisting its allure is crucial to maintaining financial discipline. Inflation, the silent thief. In a chapter dedicated to inflation, Graham warns that inflation erodes the purchasing power of money. The intelligent investor must never forget that market prices are not the ultimate measure of value. Real wealth is what remains after inflation. To counter inflation's effects, Graham advocates diversifying into stocks and bonds. Stocks have the potential to outpace inflation in the long run, while bonds provide stability. But he cautions against investing in overly long-term bonds, as their fixed returns may fail to keep up with rising prices. He also discusses the importance of dividends as a hedge against inflation. Companies with a history of consistent and increasing dividend payments are better equipped to maintain their value over time. Graham's insights on inflation remain especially relevant in today's economic environment, where inflation rates can fluctuate unpredictably, impacting both savings and investments. The wisdom of market history. Graham provides a detailed historical analysis of the stock market, demonstrating its cyclical nature. From the speculative bubbles of the 1920s to the Great Depression and post-war recovery, Graham shows that markets are driven as much by human emotion as by economic fundamentals. The stock market resembles a pendulum. It swings between unsustainable optimism and unjustified pessimism. The intelligent investor is a realist who sells to optimists and buys from pessimists. The lesson here is clear. History repeats itself. Understanding past market cycles equips you to make rational decisions when others are swayed by greed or fear. By studying market history, you gain the perspective needed to resist short-term temptations and focus on long-term goals. Graham's historical analysis includes key lessons from market crashes, emphasizing the importance of avoiding overvaluation. He also highlights the value of patience, showing that markets tend to reward those who are willing to hold their positions over the long haul. The defensive investor, strategies for stability. For those who prefer stability over excitement, Graham introduces the concept of the defensive investor. This investor seeks to preserve wealth while earning a modest return, avoiding unnecessary risks. Graham's advice for defensive investors includes: 1. Asset allocation. Maintain a balanced portfolio of stocks and bonds, typically 50-50, adjusting slightly based on market conditions. 2. Stock selection. Focus on large, established companies with a history of profitability and dividend payments. 3. Avoid overactivity. The chief problem of the investor, and even his worst enemy, is likely to be himself. Resist the temptation to trade frequently, as it often leads to poor decisions. The defensive investor's approach is designed for those who prioritize safety and simplicity over higher returns. Graham emphasizes the importance of sticking to a clear strategy and avoiding emotional decisions. The enterprising investor. For those willing to work. For enterprising investors willing to put in the time and effort, Graham outlines strategies to identify undervalued opportunities. These include small-cap stocks, companies that are often overlooked but have significant growth potential. Special situations, opportunities arising from mergers, acquisitions, or reorganizations. Contrarian investing, buying when others are selling, provided the company's fundamentals remain strong. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. However, even enterprising investors must adhere to the principles of value investing, including the critical concept of the margin of safety. They must also guard against overconfidence and ensure that their decisions are grounded in thorough analysis rather than speculation. The margin of safety, the bedrock of value investing. Graham's margin of safety is a simple but powerful idea. Invest only when a stock's price is significantly below its intrinsic value. This cushion protects against errors in judgment and unforeseen events. The margin of safety is the secret of sound investment. It makes market fluctuations work for you rather than against you. This principle applies to all investments, from stocks to bonds, and is the cornerstone of intelligent investing. Graham illustrates the margin of safety with examples, showing how it can shield investors from market volatility and downturns. He also stresses the importance of conservative estimates when calculating intrinsic value. Overestimating a company's future growth can lead to costly mistakes, underscoring the need for caution and realism. Mr. Market, the investor's partner, not his guide. One of the book's most memorable metaphors is Mr. Market, a personification of the stock market's emotional volatility. Each day, Mr. Market offers to buy your shares or sell you more at wildly fluctuating prices. Graham's advice? Treat Mr. Market as your servant, not your guide. In the short run, the market is a voting machine. In the long run, it is a weighing machine. By ignoring Mr. Market's mood swings and focusing on the intrinsic value of your investments, you can avoid the traps of emotional decision-making. Graham's insights on Mr. Market are a timeless reminder of the importance of maintaining a long-term perspective, investing in bonds and other fixed-income securities. Graham explores the role of bonds in a balanced portfolio. High-quality corporate bonds, government securities, and municipal bonds provide stability and income. However, he warns against chasing high yields, which often come with increased risk. Diversification within your bond portfolio is just as crucial as in your stock holdings. Graham's discussion of bonds includes an analysis of interest rate risk and the importance of laddering maturities to reduce exposure to rate fluctuations. He also emphasizes the need to monitor credit ratings and avoid lower quality issues that may be vulnerable during economic downturns. In later chapters, Graham provides case studies comparing pairs of companies. These examples highlight the importance of analyzing financial statements, management practices, and industry trends. They also illustrate common mistakes, such as overpaying for growth or underestimating risks. Graham's case studies include detailed discussions of balance sheets, income statements, and valuation metrics. These examples offer practical insights into how value investing principles can be applied in real-world scenarios. A philosophy for life and investing. The Intelligent Investor is more than a book about finance. It's a philosophy of life. Graham's principles, discipline, patience, and rationality, apply not only to investing, but to decision-making in general. As Graham himself writes, the best way to measure your investing success is not by whether you're beating the market, but by whether you've put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. Whether you're a defensive or enterprising investor, Graham's timeless wisdom offers the tools to achieve financial independence. By focusing on intrinsic value, maintaining a margin of safety, and resisting emotional impulses, you can navigate the complexities of the market with confidence. If you found the principles of the intelligent investor enlightening, prepare for a paradigm shift with The Millionaire Fastlane by M.J. DeMarco. This book challenges conventional wisdom about wealth and introduces strategies for achieving financial freedom faster. Subscribe now to continue your journey toward financial mastery.